Okay, we're going to continue chapter 7 today, but let's summarize what we've done so we have some perspective of what we've done, where we're going within the scope of what we're trying to do in chapter 7. Now, swaps is probably one of the much more important category of derivatives, largely because institutional investors trade swaps in over-the-counter markets where they can take large leverage bets in a wide variety of transactions, which based on different expectations. So let's summarize what we've done so far. Remember I told you I want to look at chapter 7. From the point of view of speculation, hedging, and valuation. So those are the three categories. With respect to speculation, I explained how you use CDSs, credit default swaps, plain vanilla, rate anticipation, intermarket, combination, and 5, currency. Okay, in each case, I define the swap, and then I explained the conditions under which you would execute that swap. Okay? And in addition, I spent some time explaining the plain vanilla swap in a little more detail. I told you you would execute the plain vanilla swap if you were expecting a change in volatility, but also if you had some idea about which way inflation was going. In my example between Intel and Microsoft that executed that swap, depending on whether you expected LIBOR rate to climb above 5 over the next 3 years or remain below 5 over the next 3 years, starting from 4.2%, you would take up one side of the swap or the other. There, in that case, LIBOR initially was 4.2% and the swap rate was 5%. Okay, so that particular swap, depending on whether you expected LIBOR to go from 4.2, actually the LIBOR is priced, the swap is priced as if LIBOR is going to go from 4.2 above 5 sometime in the middle of the next 3-year period. And depending on whether you agree with that or not, you take up one side of the swap or the other. If you felt it was not going to go up to 5, you take one side. If you felt it was going to go, LIBOR was going to go above 5 very quickly, you'll take the other side of the swap. Okay, that's the plain vanilla. In addition, I explained rate anticipation, intermarket, and currency swaps, all extremely important. Then, with respect to CDSs, I gave you 3 examples of credit default swaps. First, I defined the credit default swap, and I showed you how it was used during the housing crisis when we looked at the credit default swap spread of Lehman Brothers, Bear Stearns, and Goldman Sachs. How in each case it shot up from about 1 to 7.5, and that was at the edge of default, right? And in the case of Bear Stearns and Lehman Brothers, it shot up to 7.5, the credit default swap, and then poof, the firms went up in smoke. In the case of Lehman Brothers, it went up to 7.5, but the Treasury Department and the Federal Reserve stepped in to bail out AIG, that then bailed out Goldman Sachs. That's why we have Goldman Sachs in existence today. Otherwise, it would have been bankrupt as well. Okay, so that was first. The other important example where I told you credit default swaps over time have turned out to be important is after the housing crisis, but at the onset of the sovereign debt crisis, where the credit default swap spreads for both Germany and Greece were the same. And we analyzed it in class and said that doesn't make sense, right? As the sovereign debt crisis occurred, the credit default default swap of Greece would go up significantly, whereas Germany would remain pretty much where it was. And that turned out to be a right prediction. And the way you'd have made money on that is you would have taken a long position in the CDS of Greece and a short position in the CDS of Germany. Look, when I say a long position, that means you buy insurance on Greek debt. You buy it because the price is low, because they're expecting a low probability of default. Later on, as the probability of default goes up and the credit default swap spread goes up, your insurance contract turns out to be very valuable, right? So what you do is you take since the two credit default swap spreads were equally priced, and you took a long position in Greece and a short position in Germany, your net cash flow was very small or close to zero. So on a very low cash flow, as the two diverged and the credit default swap spread of Greece went up and Germany stayed down, you made tons of money in that process because your long position turned out to be very valuable. Your short position, you didn't lose much money on. Okay? And you made a lot of money. And in the most recent case, as this COVID crisis was unfolding, so if you saw from around January to February, March, right, as people were getting wind that the COVID crisis was going to get progressively worse, if you saw you can look at two other credit default swap spreads. These are what we call index swaps, which is a swap on the credit default of a basket of investment grade and a basket of high yields bonds, right? So in some sense, you're diversifying the risk across a range of investment grade and a range of high yield. But you look at the credit default swap spread on a portfolio of those two bonds, and I told you the indexes for that are, you all should look up about CDX IG, CDX HY. CDX is the indicator for the credit default swap of a portfolio of bonds. IG represents investment grade. CDX, a portfolio of bonds. HY reflects high yield. So in that case, if you had taken a long position in this and short in this, what would have happened? You bought a lot of insurance on HY bonds. As the risk of HY bonds, high yield bonds went up, your insurance contract got to be very valuable, right? And you took a short position on this. Of course, the risk of high investment grade bonds also went up. So your short position lost some money too, but it didn't lose as much as you gained over here. So on net, you'd have done very well. So those are three examples. And the number of examples of credit of swaps used by institutional investors is huge. So you need to get an over-the-counter market. I forget the name. I mentioned this last time, but if I remember it the next lecture, I'll tell you what it is. Okay, an over-the-counter market where you can trade these if you're an institutional investor. Okay, so we looked at all these examples of how you use swaps from a speculation perspective. Then I started explaining how you use this from a hedging perspective. And we looked at the plain vanilla swap from a hedging perspective, where I showed you how you could, in the example of Intel and Microsoft, right? They both have operations. And based on the nature of operations, you can minimize the financial risk by matching the cash flows to the project, matching those cash flows to the cash flow of the financing instrument they use. So for example, Intel, if it has variable cash flows, it would prefer variable rate bonds. Microsoft, if it had steady cash flows through a recession, it would prefer fixed rate bonds. And so then each firm should go out in the market and issue the types of bonds that matches the cash flow of its project to minimize its financing risk. However, the market itself may offer favorable terms on different instruments. So for example, in the case of Intel, right, where the project pointed to variable rate bonds, it could turn out that the market gave you more favorable terms for fixed rate bonds. And so what you do is you go with wherever you get the most favorable terms. If it's fixed rate, you go with fixed rate. And if it's not what you want because it doesn't match up to the cash flow characteristics of your project, you execute a swap, a plain vanilla swap, and that will convert your fixed rate bond effectively to a variable rate bond. okay, and vice versa for Microsoft. Sure. How you use, so this is an example of how you use swaps if you're in a corporate finance framework and you're hedging the business risk, okay? So what we're going to do now is we're going to look at two additional swaps. We're going to, from a hedging perspective, the combination swap and the currency swap. So we've looked at this. I'll put this in red. Whatever in blue we've looked at, we're going to look at a combination swap and a currency swap. And then with respect to valuation, we're going to look at valuation of two types of swaps, the plain vanilla swap and the currency swap. And that covers everything that we want to cover in chapter 7. Okay, so what's remaining to be done are these 4 examples. Okay, and now what we're going to do is this one. We're going to look at a combination swap. Okay, now for those of you who have your textbook, or you should pick up your textbook, I want everyone to turn to page 160. Okay, and we have 2 firms. Let's put this out over here. We're going to need a lot of this bold space. Okay. So, we have 2 firms. Let's call them AAA and BBB. Okay. Now, each one can issue either fixed or floating financing. Okay, and I'm looking at table 7.4 of your text on page 160. So, 4% or LIBOR minus 0.1%, and BBB can issue 5.2% or LIBOR plus 0.6%. Okay, so what this diagram represents is the terms offered by the market. That means AAA, now for obvious reasons we call these firms AAA and BBB. Why? Because this is AAA, a firm issuing AAA rated bonds, and a firm issuing BBB rated bonds, and the options available to them are fixed or floating rate debt, right? And so you can see we're talking about a swap between different markets, intermarket versus fixed versus floating. So that's this combination, the combination swap. That's this red arrow that I'm looking at. So these are the terms offered by the market. Okay? Okay. Now, let's see how these guys execute the swap. Okay, I'm going to draw a diagram over here. AAA, BBB, okay, now AAA and BBB, they have to try and figure out, well, what does this diagram tell us? Remember, this is what the market offers. This is out of your control. Okay, this is what the investment bank will tell you. If you want to issue fixed rate, given your risk, it's going to be 5.2 or LIBOR plus this. You take your pick. That's what the investment bank will say. Same thing, AAA. Your AAA, if you want to issue fixed, it's 4 point. If you want to issue floating, that's the rate you pay. Take your pick. So the first question is, how does AAA and BBB decide which one to pick? The way you do that is as follows. You first take the difference of these two. And I'm not talking about the sign, negative or positive, just the difference, 1.2%. And the difference of this is 0.7%. Okay, let's see what those numbers mean. Okay, this 1.2% represents the added interest rate that BBB has to pay for its risk above AAA. Because BBB is more risky, right? It has to pay a higher interest rate relative to pay AAA. But how much more is the market charging you? 1.2%, right? Then look at floating rate. AAA again pays LIBOR minus 0.1%. Triple B pays LIBOR plus 0.6%. The difference is 0.7%. So triple B is more risky than triple A, but how much additional interest rate does triple B pay relative to triple A in the variable rate market? And the answer is 0.7. So the thing is this, from triple B's point of view, what type of debt lets it get away with paying a smaller premium? Okay? This. So if triple B were to decide between fixed and floating, which one should triple B pick? I've highlighted in green. Why? Because there, the premium it pays relative to triple A for its added risk is lower than the premium it pays over here. Okay, so let's fill that up in the diagram over here. Triple B would issue LIBOR plus 0.7%. Okay, let's put LIBOR plus 0. So that's the interest it pays. Okay, now let's go to triple A. What would triple A do? Triple A is less risky than triple B. So it pays a discount. It gets a discount on the interest rate it pays relative to triple B. Now, in the fixed rate market, what is triple A's discount relative to triple B? It is 1.2%. What is triple A's discount relative to triple B in the variable rate market? Its discount is 0.7. So where does triple A get a bigger discount? In the fixed rate market. So that's where. So now, if let's just do this. So triple B, this is LIBOR plus 0.7%. Over here, triple A would issue 4. So in other words, that represents where each firm gets the most favorable terms in the market. Okay, the next question is, what does AAA and triple B actually want relative to its projects? Now, for that you have to look at the cash flows. How steady are the cash flows relative to the business cycle? So suppose AAA's cash flows were steady relative to the business cycle, and it preferred to issue, and it has steady cash flows. So if it has steady cash flows from its project, it doesn't mind making steady cash flow payments on its debt. So in which case, if AAA had steady cash flows, it would prefer fixed. But if it gets the most favorable terms on fixed and it prefers fixed, it's done. There's nothing more to do. Similarly, if triple B, right? So imagine this was, for simplicity, remember the example Microsoft and Intel? Suppose AAA was Microsoft. Microsoft has steady cash flows from its projects, right? And therefore it wants fixed rate debt. But the market offers it the most favorable terms in fixed rate debt. It's done. Say this is Intel. The market offers Intel the most favorable terms on variable rate debt. Its cash flows from its projects fluctuate with the business cycle. It wants variable rate debt. It's done. In other words, each guy gets what they want from the market at the best rate. It's pretty much like this, right? You go to a store, they have a sale, and usually invariably something's on sale or something's not on sale, right? Now, if you happened to look for coffee and coffee happened to be on sale at Publix, what would you say? Great, I'll take my coffee, I'm done. Okay, but what happens is, suppose you prefer coffee, but tea is on sale at Publix, then what do you do? Shit. Maybe I'll buy tea, and then I'll go to the farmer's swap market and try and swap my tea out for coffee. You follow? So that's the analogy over here. So now imagine the case. We reverse these two, where this represents Intel and this represents Microsoft. Suppose, right? Then you say, okay, Intel, what it likes based on its projects is variable rate debt, but it's getting the most favorable terms in fixed. So what I'm going to do is, at the top over here, I'm going to write what it prefers based on its projects. Variable, fixed. So, where does the market offer most favorable terms? Fixed. What does it want? Variable. Okay, there's an issue we need to fix. What does Microsoft, the market offers most favorable terms in variable. What does it want? Fixed. There's a conflict, we need to fix that. So in that case, what do you do when there's a conflict? When there's a conflict of what you want and what the best terms on what you want and what you really can get, then what you need to do is always, as a rule, always go where the market offers the most favorable terms. That means through this exercise, resulting in this. You always go where the market offers the most favorable terms. And then ask, is that what you want? If it's not, if it's what you want, you're done. If it's not what you want, then you execute a swap. Okay? So in this case, in both cases, this is not what they want. This fellow wants fixed, but he's getting the most favorable terms on variable. This fellow wants variable, he's getting the most favorable terms on fixed. So they go where the market offers the most favorable terms, and then they execute the swap. So now let's put in the swap over here. Okay, I want everyone to look at page 161, table 6.7. That's where the swap is. So the swap is structured as follows. No, I don't use green for that. I use red. LIBOR for fixed 8%. So now, that's the terms of the swap. Now, this swap, combination swap, it looks similar to the plain vanilla swap, but understand, the plain vanilla swap is a market instrument, right? So the 5% rate we saw, right, for that swap is a market instrument. It's determined by supply and demand conditions, okay? Now, in the case of this combination swap, this is an over-the-counter swap structured for two specific firms, okay? And so the terms of this swap have to be negotiated. Okay, so now, one side of the swap is always LIBOR, the other side is fixed. But we have to figure out who determines what this fixed rate is. It's not the market. You don't get it from the 3-year plain vanilla swap and stick that 5% over here, no. Okay, this is an over-the-counter swap. So how do you determine this? Okay, if you look at the textbook gives you the answer. If you look at figure 7.6, it gives it as 4.35%. So what I'm going to do is I'm going to write 4.35% over here. Okay, now, of course, what the textbook doesn't tell you, or it may tell you somewhere in there if you read it really carefully, but what the textbook doesn't tell you, or it may tell you after reading it a lot, is how did it get 4.35%? Because that figure just throws 4.35% on. How did they get it? So the way we're going to solve this is we're going to solve strictly, you should have x over there and solve for x. That's what you need to be able to do. And on the test, you could get a problem where I give you a question like this, right? And you have to solve for x. Okay, so we do this the same way you do your homework problems, where, you know, I give you a problem, you don't know how to do it. So you turn to the end of the book and you see the answer. This is the answer. Then you play around with the numbers and see how you get that answer. And if you get the answer, you figured out Maybe you figured it out correctly, right? So that's how students do this, right? Okay. At least I used to do that as a student. Maybe you guys do it too. Anyway, so coming back to this, let's see, the answer is given as 4.35. Let's figure out the method they got that answer. Okay, so the first thing we do is, remember, we draw a green circle around this. What's the purpose of the green circle? To net things out and figure out what the net effect of issuing fixed rate and the swap is. Okay? Remember what the arrows represent. All arrows pointing into the firm are cash inflows. All arrows pointing out correspond to cash outflows. Okay, so, and look, you have two fixed and one variable for AAA. So we can net out the two fixed first. There is 4.35 coming in and 4 going out. What is the net effect of that? 0.35 coming in. 0.35 coming in plus LIBOR going out. So what is the net effect of that? LIBOR minus 0.35 going out. Okay? Then I can draw a circle around triple B. Okay, again, over here we have 2 LIBOR and 1 fixed. So let's net out the 2 LIBOR first. There's LIBOR coming in and LIBOR plus 0.7 going out. So what is the net effect of that? 0.7 going out. And 0.7 going out, and this is 4.35 going out. So what is the net effect of that? 5.05 going out. Hope I did that correctly. That is 4.35, 5.05, correct. Okay. Okay, so now I want you to look at these numbers and look at these numbers. I don't know if I did that correctly. 4.35. Oh no, that's not 0.7. Notice this is 0.6. Sorry. This is LIBOR. Okay, so when I net that out, this is 4.95 going out. Okay, now I want you to see, okay, now this is a variable rate. This is variable, the firm wants variable, it gets what it wants. This is fixed, the firm wants fixed, it gets what it wants. Okay, now let's go back over here. Okay, let's look at AAA first. AAA always wanted variable. AAA could have gone to the variable rate market and issued it this, if it didn't want to go through all this trouble, right? And just gone to the variable rate market. What would it have paid? LIBOR minus 0.01. How much is it paying over here? LIBOR plus minus 0.35. So how much did AAA save? It saved this. Look at this. It would have paid LIBOR minus 0.1% if it went directly in the floating rate market. But over here, what is it paying? By going around this rigmarole, by issuing a fixed rate and a swap, it pays this. LIBOR minus 0.35. So how much is it saving? This is 25 basis point or quarter percentage point. This is less than this. So that's its savings. Now, triple B could have gone to the fixed rate market. Remember, triple B wants fixed. It does get fixed over here, but suppose it didn't want to go through all this rigmarole and just went straight to the fixed rate market. What would it have paid? 5.2. But what is it paying over here? 4.95. So how much did it save? 4.25%, 0.25. So each firm saves so much. Now, if you ask, what is the total saving? This plus this is equal to 0.5%. That's the total saving. So the total is divided, there's a total saving as a result of going by this roundabout method, and they divided the savings equally. Now I want you to come back over here. Remember, we calculated this difference over here to see where each firm had a comparative advantage. AAA fixed, triple B floating. That's how we got these two arrows. Okay? But look at the difference between this and this. What is that difference? This difference is 0.5%. That is the same as the total saving, 0.5%. Do you see that? So in other words, we get a clue about how to solve this problem. And the clue is this. Whenever you get a problem of this type, the first thing is, this difference tells us where each firm should go, fixed or variable rate, the first difference. The second difference tells us the total amount saved by going through this process, right? And then this exercise shows that that saving is divided equally between the two guys. Now what we can do is go back and solve this problem correctly, okay? So what I'm going to do is erase this and write X%, because I don't know what X is. Okay? And then I'll go back and erase all of this stuff. Because notice that problem was solved conditional on knowing the answer, right? In reality, I don't know the answer, so that exercise is meaningless. It's only meaningful in the sense that it helps you understand what's going on in this example. But now we generalize this. And we say, okay, now let's calculate this out. Suppose the answer is, we write it as X. Let's net this out for AAA. The net outflow is what? Look, I have 4 going, X coming in and 4 going out. And I want to calculate the net going out. Okay. So there's LIBOR going out, there is 4 going out, and X coming in. So there's 4 going out, LIBOR going out, and X coming in. 4 going out, LIBOR going out, X coming in. So this is the net. Notice I'm putting this arrow just below this, so it represents the net cash outflow with respect to A's point of view, right? So this is it. So this is the net cash flow going out. Now, if AAA, so this is a variable rate. If AAA had gone to the variable rate market, directly it would have paid this LIBOR minus 0.1%. Let's get rid of this percent, 0.1. Okay, so now the question is this. This is what it pays by this roundabout method. This is what it pays if it went directly. And if you're going by this roundabout method, you better do better than that. So in other words, you'll only go about this roundabout method if this is less than that, right? So, but less by how much? Less by how much? That means it has to be less than this by a certain amount to make it worth your while. But how much is there to be had? How much is there to be had between the two parties? That's why I put this in red. It's this difference. 0.5% represents the size of the pie that AAA and BBB can divide among themselves. This is the savings. How are they going to divide the savings? So suppose we give half the savings to each guy. So we're nice. We have one pie. You take 50% of the pie. I'll take 50% of the pie. So this is less than this by 25 basis points, right? To make this an equal sign, we have to land up with this. So this is to make this an equality, let me do it over here. I said the left-hand side has to be less than the right-hand side. But less by how much? Less by how much? It has to be less than the right-hand side by 0.25. That is, this is the savings, and we're saying in our example, we're going to divide the savings equally between the two guys, and this is the savings of each guy, AAA, BBB. Okay, and this is the 0.25 over here. So the left-hand side is less than the right-hand side by 0.25. So if I subtract 0.25 from the right-hand side, then these two become an equality. Okay, so think about that. The left-hand side is less than the right-hand side by 0.25. That means if I subtract 0.25 from the right-hand side, then the left-hand side should be equal to the right-hand side. So now, if I solve this equation for x, what will I get? L and L will cancel. Okay, I take x onto that side, and I bring everything else over here onto this side, and what do I get? 4 plus 0.1 plus 0.25 is equal to x. And if I simplify all this, I'll get 4.35, which was what we had over here. So that's how you solve for x. Now, I could repeat this exercise over here, right? What I could do is net out this circle, LIBOR, x, and again, apply the same principle and solve for x, and I'll get the same answer. So I don't have to repeat this exercise on both sides. I just have to do it on one side, right? And I get the thing. So on the test, I could change this problem a little, right? Over here, I'm nice enough to say, so let me say, I'm going to put this in red. Why do I put this in red? Because that's the savings over here. Okay, and I solve for x. But suppose I'm not that nice. I'm AAA and I'm not all that nice. And you know, say AAA has a lot more market power than BBB. What AAA will say is, we're not going to take this pie, 50 basis point pie, and divide it equally. But I want a bigger part of the pie. So suppose we divide this so AAA gets 30 basis points and BBB gets 20 basis points. So we don't divide it evenly. Okay? Then AAA, right, will get an interest rate which is lower. This is the rate it got in the market if it went directly. Its rate will be lower by how much? Its rate will be lower by 30 basis points because it took 30 basis points of the pie. And then you solve this for x and you get the new terms of the swap. And what will the new terms of the swap be if I brought this over? It'll be 4.40. Right? Because I'll get this minus 0.25 will become plus 0.30. And then if I add that all up, 4.1, 0.3, I'll get 4.4. So that will be the new terms of the swap. Then this would not be this, but 4.40%. So that example illustrates how the textbook shows you, gives you the answer of the terms of the swap if it's divided evenly. But I illustrated over here. You can generalize it where the pie is defined as the difference of the difference, that is this thing in red, which is the size of the pie to be divided between the two parties. They can be divided asymmetrically. How that will change the terms of the swap. Okay, so with that in mind, we are done with this. That's the combination swap. Okay, now I'm going to erase some of this stuff and we're going to do the next one, the currency swap. So notice over here again, this is a hedging example. It illustrates how you manage the financing risk of the firm to match up to the operations of the business. Okay, so let's erase some of this stuff. I'm going to keep this template over here because this template is the one that tells you what are the topics we're going to cover. Okay, for the next exercise, show you a currency swap and how it's used from a hedging perspective. I want everyone to turn to page I want everyone to turn to page 171. Okay, in table 7.8, we see two firms, okay? And I'm going to put that table up. You'll see the similarity between this. In the previous example, which I'll leave that to you to wrap up. There was one additional part, but I erased all this stuff. So that was example figure 7.6. And if you go to figure 7.7, it tells you how you would modify the swap if you had a financial institution, right? That requires a commission. So if you add the intermediary, so notice we obtain the swap without the financial intermediary. But once you add in the financial intermediary, the intermediary wants some commission, right? And in the previous example, for the plain vanilla swap, we said the intermediary wanted 3 basis points, and each guy had to give up 1.5 basis points. In this example, the combination swap, each guy, the investment banks wants 4 basis points, and each firm has to give up 2 basis points. So you'll see that example, how instead of 4.5 going through, you'll see 4.37 going into the investment bank and 4.33 going out. Okay?